Everything's got fucking crazy, Caitlin. And you're my resident expert on the banking sector. Oh, I think we had to do an emergency broadcast. What the hell is going on?
Well, look, the banking system, as we all know, has been always inherently unstable, because if everybody goes and gets their deposits back at the same time, the system is insolvent, and therefore the insolvency gets revealed. It's not like there's anything new that comes to the fore, because the insolvency has always been there in aggregate. But the reality is that technology and information and social media allow people to move money faster than they ever have before. And as a result, a lot of banks that are tech forward should have been sitting on 100% cash to back their customers' demand deposits. And instead they got greedy, and they were rolling the dice, investing in long-term treasuries instead of in cash. And as a result, when everybody showed up to get their deposits at the same time, poof.
Right, let's work through this. There's three specific banks we want to talk about, and there are different scenarios. I've got Silvergate, Silicon Valley, and Signature. I'm including Silvergate just so people listening understand that it is a different scenario what happened with them, but we should at least explain what happened to Silvergate.
Yes. Well, Silvergate was the one. I was watching actually both Silvergate and Signature. I'm on the record that I was warning the bank regulators. There was bank run risk all over the banks banking this sector, and I did it months before the bank runs actually hit. Okay, and I think this is interesting because Custodia, my bank, has a 100% reserve non-lending model. Our proposal was to keep 100% of customers' demand deposits on deposit at the Fed, and the Fed called that unsafe and unsound. Yet what has happened is that Fed-regulated banks like Silvergate and Silicon Valley Bank, for example, they were the unsafe and unsound ones because the Fed let them do the following. And I'll quote numbers that I know off the top of my head from the March 31st, 2022 Silvergate 10Q SEC filing. Silvergate had $13.3 billion of demand deposits that could be withdrawn in the span of literally seconds through the Send network and through API-based FedWire transactions. 13.3 billion could be withdrawn like that. And guess what? 1.4 billion of cash on hand. So when that bank run started, it was pretty fast that the bank unfortunately failed. Now, that was a risk management decision that, again, the Fed, as the bank regulator, let them take. There is, I think, a bias towards fractional reserve banking, borrowing short and lending long. And that is literally what Silvergate did. What else did they invest the $13.3 billion of customer deposits in, less the $1.4 billion of cash that they had on hand? Long-term treasury bonds and mortgage securities. They were reaching for yield, and they did it at the precise moment when interest rates started to rise. The Fed started raising interest rates almost exactly a year ago, and into an incredibly fast rate rise environment, these banks invested all the new deposits that were coming in. This is exactly what happened at Silvergate and Signature, at Silicon Valley and Signature as well. They had a big increase in deposits, and they invested in long-term treasuries. And so what happens with those long-term treasuries when interest rates rise is the value of the long-term treasuries falls. And some of those things are trading, some of the mortgages in particular, long-term mortgage-backed securities, are trading at 60, 70 cents on the dollar right now because of the big increase in interest rates.
Right, okay. So Silvergate themselves, you mentioned they had like 1.4 billion in cash.
Yep.
In the scenario where there's a run and people were trying to withdraw the deposits, if you're holding your money with the Fed, can you just withdraw as and when you require? You don't actually have to keep it all within your bank. So that's how a full, if it was a full reserve bank like Custodia would work, you would constantly have access to the full liquidity of customers.
During bank hours. So while FedWire is open. Yes, not 24/7, 365. Just to be clear, both Silvergate and Signature offered 24/7, 365 debits and credits among customers of the bank. So both customers on the transactions had to be customers of the bank in order to use SEN or Signet, which were the 24/7, 365 platform that allowed customers to basically just swap balances. But any money that needed to actually leave the bank has to be done during banking hours. And that, of course, would apply to Custodia had we been granted a FedMaster account yet as well.
Yeah. I'm going to come back to Custodia because Lynn Alden mentioned another bank on Twitter yesterday, where she's talked about them not being given a banking license by the Fed because they were
5 years.
For 5 years, because they had a policy similar to yours of being Federal Reserve. Okay, let's get into Silicon Valley Bank because this has been the big trigger. This is the largest bank failing since 2008.
Yeah.
What was unique about what happened with Silicon Valley Bank?
Well, that was an even faster bank run than crypto. So I know the White House talking points yesterday were trying to blame all this on crypto. And there is an interesting supporting fact related to Signature. I'll come back to Silicon Valley Bank in a moment, but Signature, Barney Frank of Dodd-Frank fame, was a director of Signature, and he came out and made an incredible statement yesterday, which is that Signature they did have $10 billion of withdrawals on Friday, but they were still solvent. And the bank regulators moved in to put them in resolution almost as though, well, he said as an anti-crypto move, okay? So I think Signature, there's something interesting happened there, and there will be an investigation, and it will question the bank regulators whether they pulled the trigger too fast on Signature. But that's relevant for back to the question you asked, because the bank runs that were happening at two of the banks that were actively serving the crypto industry, Silvergate and Signature, happened more slowly than the bank run at Silicon Valley Bank. So the tendency, the White House talking point to say, oh, this is all related to crypto, it's just simply not true. So back to your question, Silicon Valley Bank in 44 hours had essentially a 100% withdrawal of deposits, demand deposits. And in one case, it basically within the span of a few hours, it looked like 25% of their uninsured deposits were withdrawn, 45 billion. Okay, so now let's step back and ask, how can this happen? First of all, it should have been anticipated by the risk managers of the bank, the management of the bank as a whole, and by the bank regulators. Why? Because we now have API-based banking. So Silicon Valley Bank didn't do the crypto thing. Silicon Valley Bank had APIs that allowed all of its tech-forward customers to use software to direct payments into and out of those deposit accounts, okay? APIs are very different than having to go down to the local branch, wait in line, fill out a form by hand, and then, have a FedWire directed to your new bank account at another bank. So naturally, because you have technology, the tech-forward banks are going to have to be, they have the ability to move money so much faster. It still settles through the FedWire system within hours, but the initial instruction that came into Silicon Valley Bank happened so much faster than the bank regulators had anticipated. They should have required the tech-forward banks to be sitting 100% in cash to back customer demand deposits should a event like what happened last Thursday ever occur. This is not rocket science, Peter. I cannot believe that the banks were allowed to do this borrow short, lend long strategy when everyone knew those deposits were volatile. And because you can direct the wire transfers from your phone and do it electronically, and by the way, you could do it through software using APIs, the whole concept of a bank run sped up. Now, I will also add, it didn't happen yet, but I think the Fed dodged an even bigger bullet because FedNow, which is the Fed's 24/7, 365 real-time gross settlement payments system, that's coming online this summer. Now, it's limited to $100,000, but now, all of a sudden, you can have a bank run at, 11:59 p.m. on a Saturday night okay? Because people are going to be able to move money 24/7, 365 in real time. And I have not seen the bank regulators yet acknowledge that the banks are going to need more liquidity. The impact of all of this is that the Fed needs to require banks, especially the tech-forward banks, to sit on 100% cash to back demand deposits. By the way, almost no banks do that. But the other impact is the Fed just across the board is going to need to help to expand its balance sheet. As soon as this happened, I tweeted, end of QT incoming. Quantitative tightening, the Fed shrinking its balance sheet, disproportionately hit the community banks. And these are the ones that are having the problems. And the impact of all that is the Fed's going to end up having to expand its balance sheet again to proverbially print money in order to provide the extra cash for the banks to be able to meet the demand deposit withdrawal. The banks should have been sitting on that cash all along.
Oh my God, there's so much to get into there. Okay, let me start with Silicon Valley Bank. So you mentioned there that the Fed should have required them to be holding 100% deposits in cash. Okay, so
their demand deposits, yes.
Yeah, to make their demand deposits. Is that a specific different regulation that should have existed for tech-focused banks? And how would they do that? Or are you saying that all banks should be doing this?
Oh, all banks should be doing this. I just saw an analysis of all the publicly traded banks that looked at their demand deposits relative to their cash. And in this analysis, they also added available for sale securities. I wouldn't do that because, as we've talked about before, to sell a security, it takes you 2 days to settle the security. For treasuries, it takes you 1 day, right? So if you can have a bank run in the span of 44 hours, I don't even think you should be looking at available for sale securities as part of the liquidity portfolio. I think you should be looking at good old-fashioned cash on deposit at the Fed. Okay, so the Fed's balance sheet effectively should be as big as all the demand deposits in the entire banking system. And it's not. It's a tiny fraction. 95% of the banks on this analysis that I looked at yesterday hold less cash plus available for sale securities than their demand deposits, which means if everybody goes and withdraws their money at the same time, the Fed is the backstop, and it's going to have to massively expand its balance sheet to create the cash to satisfy the withdrawals.
Yeah, I've got it here that Signature had just over 5% of its assets in cash. Silicon Valley had 7%, compared to an industry average of 13%.
See, but this is the thing, right? They had volatile deposits. Those that serve the crypto industry, this is what Wyoming knew, all right? And you've made trips to Wyoming. You know full well that Wyoming knew that digital assets move at the speed of light, okay? And so anyone who's serving this industry naturally should have been sitting 100% in cash. And the fact that they weren't it blows my mind. It ultimately, the management teams and the shareholders paid the ultimate price for that because they've been wiped out, as they should be, because they made a bad risk management decision.